Hey everybody, it's Matt Bowles. Welcome to the webinar. This is going to be a super exciting event tonight. I see a whole bunch of people jumping on right now. We want to start this right at the top of the hour so we don't waste a single minute. We have with us tonight a super special guest for this webinar. This is about how to use the new Trump tax plan to make more money and pay less tax with real estate. We have been getting so many questions about all of the tax changes and particularly how they apply to real estate investors and how to navigate all of this. And so what I have done is brought one of the premier experts in the country to share with you an update and an overview and help us all make sense of this. So I am super excited about this event tonight. Let's just start with some housekeeping items. You've got a chat box control panel on the right-hand side of your screen. You're going to be able to communicate with us through that. So if you want, you can just type in right now. Just let's test, make sure it's working, and let us know where you are tuning in from tonight. And let us know if this is your first Maverick Investor Group webinar ever, or if you've been with us before on one of our previous webinars. So cool. All right. So I recognize a whole bunch of people here tonight that I know. James, Rossi just hung out very recently in person. In fact, good to see you. A whole bunch of new people as well. Wow, cool. Awesome. And then some clients that are coming back after a while that I haven't seen in a while. So fun to see everybody. I won't read through all the names because there's a ton of them here and a lot more coming on. And I want to get into this tonight. So let's jump right into this just for the people who have not been on a Maverick event before. Real quick, I am the co-founder and co-owner of Maverick Investor Group. We started back in 2007. I'm also the host of the Maverick Show podcast, available on iTunes, Stitcher, Spotify, or anywhere you listen to podcasts. You can see I've got my gear set up here tonight in the studio. And if you haven't connected with us before, what we do basically is we help individual real estate investors by performing rental properties in the best U.S. real estate markets, regardless of where they live. So these are turnkey properties, single family homes, usually sometimes 2 to 4 unit properties. They're fully renovated, tenants already in place, local property management already in place. So we help our clients to mitigate the risk involved with rehabbing properties and incurring all that initial holding costs and vacancy rate and everything. So you're able to close on a performing property, do your due diligence, and then as soon as you close, you cash flow from day one, and you don't have to be restricted to your local markets. You can buy in the best markets, and those, of course, change over time. So we help our clients build and diversify their real estate investing portfolio over time and across markets. The other thing that we do is we help you to connect with other real estate services, vendors, and experts that you're going to need on your team to be successful in real estate investing. Okay, so even if we can help you buy great properties, you still need, for example, a CPA who's going to be able to help you out and navigate all of the amazing tax benefits, of course, of real estate. It is the most tax advantaged asset class in the country, bar none. But you need to know how to take those tax benefits and how to take them right. And that depends on your individual situation and applicable law and all of that. And so you really need to be consulting with somebody that really knows their stuff on that. And especially as all these new laws come down, the new Trump tax plan and everything else, and all sorts of things have changed. And that's why tonight I am super excited to bring you Diane Kennedy. She is a New York Times best-selling author of Loopholes of the Rich and Real Estate Loopholes, and at least 6 other books, all of which are on my bookshelf and heavily underlined. She herself is a business owner, a real estate investor, and the founder of the renowned CPA firm U.S. Tax Aid. I have known Diane now, I think, for 12 years. I have paid over $5,000 per seminar to attend Diane Kennedy seminars over the years. I have gotten a lot more value than that out of those seminars. And Diane has actually been her firm has been my personal CPA and the CPA firm for Maverick Investor Group for many, many years. And so that's one of the reasons that she was willing to come here tonight. And because I asked her, I said, can you please, we're getting tons of questions about this new Trump tax plan. Would you possibly be able to put together some content and do about a 1-hour session for our group to help people navigate and understand what's going on? And she was very gracious enough to do it. So Diane, thank you so much for that. And thank you for being here tonight.
Well, I got to say, my favorite group to always talk to are real estate investors. And that's because my husband and I have been doing that for decades, literally. There's just so much that we've got right now with the Trump tax plan, and a lot of things have changed. And if you've got a tax strategy plan that you've put together before, you're going to want to pay attention today because things are different. I'm going to go ahead and take over running the slides. Is that okay, Matt?
Yep, go right ahead.
Okay. Let's see. There we go. Okay. So this is my promise to you. I know that you've got an evening here. You've given up for this and you're going to spend an hour or so and you've got other things to do. So I'm going to make a promise to you. I'm going to give you a very clear step-by-step roadmap on how you can navigate through this Trump tax plan. And, the bottom line is you're paying less tax, you're putting more cash flow in your pocket. Plus, you need to protect your assets. You need to build up an IRS audit defense and use all of this new tax law to your advantage. But if you think the way it used to work is the same, it hasn't. And I'm going to hit the high notes of those kinds of things tonight. If you hang on to the end, and I sure hope you do. And by the way, I know we're going to be working in some question and answers too. So if you've got questions, we'll be able to take those. But at the end, I'm going to give you a special bonus. It's a PDF that's a cheat sheet of the questions that you need to ask regarding yourself as an investor and your property, so you know which of these new Trump tax plan loopholes you can use and which maybe aren't going to be a good fit. But unfortunately, there's so much data right now that people are just getting buried. I do a coaching program every 2 weeks, and I found that most of the people right now in the coaching program are other tax professionals. And that's because we're all so busy, and every time the IRS turns around, they give us another 1,000 pages or so to explain this new tax act. And we, in fact, got one just a few months ago that is retroactive to January 1st, 2018. So over a year late. So that's why it's so confusing. I'm going to give you a cheat sheet. You got to hang on to the end, though. And by the way, it's completely free. So you're going to get the link to that. Okay. So just a little bit, I talked for a second about who I was as far as my professional career. My husband, you'll see pictures of my husband and I and our son, daughter-in-law, and little granddaughter. We have always invested in real estate. I have an online business, which is my CPA practice. And we live where we want to. Right now, this is pictures from our beach house, and we're right now in escrow on a horse property. And so it's kind of, that's one of the big benefits that I see with real estate. And I'm hoping that you're experiencing that too with your real estate that you've got, especially once you know those tax breaks where you can create cash flow that you don't pay any tax on at all, which is amazing when you think about that for any investments. So that's just a little snapshot of my life at the beach. We also are involved in charities. That's, I think, another big thing that you get the advantage of when you start having those passive incomes. What you're going to see there is a whole bunch of pictures of Great Danes. The two at the top are 2 Great Dane rescues that we have, and they're running along the beach. The bottom 3 are from a group that we just recently rescued. It was a dog fighting group that had been broken up. And they had the puppies there because they were going to use them as bait dogs for training the other dogs. These dogs that we were able to rescue, and they've all got amazing homes now. 2 of them are on a ranch, and the other is traveling with a vet tech, so somebody who really understands dogs. So the idea is, I think, for a lot of us, we're looking for a way to spend more time with our family, to give back to causes we've got. And I'm going to just share a little bit of something that I haven't even actually really gone public on until today. Matt Bowles and I have been friends for 13 years. And I was talking a little bit about him, and I said, I want to talk about this. So 2 years ago, I was diagnosed with a bone disease, and I was in a wheelchair. And I was told that you're never going to walk again. Well, I went through stem cell. I went through a lot of different changes in my life, and I'm able to walk. And I now have a service dog who helps me walk. And that's what you see pictures of right there is my service dog, Louie, in the other room. But the reality is that when you have options in your life, these setbacks that happen don't have to throw at you. So whatever your reason is for investing in real estate, I just want to encourage you on that path, and I want to help you do that. So that's a little bit of why it's so important to me. So let's just get down to it. Why do the world's richest families earn and or hold their wealth in real estate? You might have heard this before. A lot of people make money with real estate, and I think even more hold their wealth in real estate. There's 4 main reasons. One is you create cash flow. The second is you've got appreciation. You either have passive appreciation or you can have active appreciation, where you get a property and you make it more valuable. That's the kind of thing that Matt does with his team. They find a way to get tenants that give you the best possible return on your money. So over time, it becomes even more valuable because, trust me, there's lots of people that are looking for, how can I invest some money and have this return for that money? You can put it in the stock market and pray, or buy crypto, and we all know what's happened to that over the last 18 months or so. But with real estate, you've got something that over time, when you have cash flow, it continues. And then the one I talk about all the time is taxes. Any of the other things I talked about, crypto, stock, your business, you're going to pay tax on the income. I don't know anything else that gives you so many tax breaks that you could actually create cash flow and then that puts money in your pocket, and not only not pay any tax on it, but get another write-off that goes against your other income. So that's a huge part. And then the final one is that once you get your system dialed in, you may want to consider leverage, because all leverage does, and by that I'm talking about loans, all leverage does is whatever you're doing, it makes it bigger. So if you're doing something right, then you get more right. If you're doing something wrong, you have to be careful, because it can make it worse. So the idea is that you have those 4 tools when you have real estate. But it becomes that there's more. Oh, and before I get into this too deeply, the lawyers always make me say certain things. And basically it says that real estate that you buy, every piece of real estate is going to be different. Your own circumstances are going to be different than the next guy. I mean, what might be a great deal for me is not a great deal for you, and vice versa, because we're different. And that's what this is talking about, that you need to make sure that you have a customized plan with advisors who understand what's going on. Be careful whenever you hear just general advice, especially like on social media, because chances are people don't really understand exactly your situation, and maybe they don't understand the situation at all, and they're giving you bad advice. I see that all the time. So just be careful. Make sure that you're getting the best advice for your own circumstances. Okay, so through this, what we're going to cover today, I'm going to ask you 5 questions, or 5 things for you to consider about your real estate. The first question is, do you have a real estate business? Do you have real estate investments? Do you have a self-rental? And actually right now we've got another little subheading we need to consider, and that is, if you're renting something out, have you lived in that property for any part of the year? Okay, so let's start with the big question first. Is it a real estate business or a real estate investment? Now, the answer to that is going to make a difference in the type of entity you want to have, what kind of business structure, how you can take a write-off, how you get to take advantage of the new 20% income deduction, more on that in a little bit, and how you need to keep your records. Big difference. Okay, so for a real estate business, there's primarily 2 different ways you might have what the IRS considers a real estate business. One is if you're involved in buying property and then either fixing and flipping it, or just wholesaling, selling it. But the general idea is you're buying property that you're just going to hold for a short period of time and then sell for more money. That's how you make money. Well, if you're flipping properties or flipping burgers, are both businesses. That's a real estate business. The other one that we're starting to see more of are if you rent out a property for short stays and provide what we call substantial services. And an example of that is Airbnb. If you've got a rental where people are coming in and out, staying for less than an average of a week, and the substantial services in this case are probably maid services, then you have a real estate business. Now, we're going to talk more about that, but just in general with a real estate business, if you have a tax loss, it's easier to take that loss against your other income. So in some ways, a real estate business is actually better. By the way, how do we get tax losses? I'm going to talk about that as well. Typically, that's with depreciation, because the whole point is not to lose money. You want to make money, but on taxes, you want to show a loss. The two rules in order to be able to take that tax loss: one is you have to have enough basis, in other words, loans that you've signed for and you put enough money in, and you have to have what's called active participation, which is a pretty low standard. It just means that you're actively involved. It doesn't mean you're out there fixing things, swinging a hammer, or doing any of that. You're just the person that other people talk to about it. A real estate passive investment is probably what most of you have got. I'm just going to make a guess here. And that means that you've got property that you're buying, either commercial or residential, and you're holding it for long-term stays. The fact is, it is passive. You're not having to constantly be worrying about the next deal. You don't have to fix anything up. You're not churning it. You're not worrying about the next tenant coming with Airbnb. You've got long-term tenants that make it a little easier. Now, for tax purposes, if you have a tax loss, it can be a little harder to take that write-off. Generally speaking, if you make less than $100,000 of adjusted gross income is what we used to say was the bottom of the front page of your 1040. The forms have all changed. If you haven't noticed that already for 2018, it's all different. But it's basically the sum of your W-2 income, your interest, your dividends, that kind of thing, and then less, you subtract off pensions and a few things like that. Not very many anymore. We lost a lot of those deductions. That gets you to your adjusted gross income. If that's less than $100,000, then you can take up to $25,000 of a passive loss against that. If that number is above $150,000, you don't get any deduction at all. Between $100,000 and $150,000, the amount you can deduct phases out. There is an exception if you're a real estate professional, and I'm going to talk about that as well. Now, the other new category that we have to be especially concerned about, starting with the Trump tax plan, is something we call a self-rental. What that means is you buy a building that your business rents. So I have clients that, let's just say a doctor. A doctor has an office where he sees patients. He may decide to buy that building and then rent it to himself. You know, you typically don't want to have your business and your real estate in the same business structure. That's just good for asset protection. So his business might be operating as, let's just say, a corporation, and then his building itself would be held inside an LLC. They're two separate entities. The corporation pays rent to the LLC. Now, this is where it gets tricky. If you've got something like that, your goal here is to have that rent be enough that it zeroes out when you take all the expenses. If you have a loss, you cannot take that loss no matter what against your other income. So that's a big deal. You got to make sure you got enough rent you're collecting. And on the other hand, if your income is higher so that there's actually ends up with profit inside that LLC, you might run into a problem taking that 20% income deduction. So that self-rental is a little tricky. The key here is to try to get that to zero. One more thing, if you have a home that you live in for part of the year and you rent out for the rest of the year, if it's a long-term rental, you do not get the 20% income deduction. If it's a short-term rental, in other words, you do the Airbnb kind of thing for part of the year, then you do get that 20% deduction. Yeah, and don't be, if your head's spinning a little bit, by the way, that's just the first question. Don't worry, hang on till the end. You're going to get that PDF. So, Matt, you okay over there?
No, I'm good. This is all really good stuff. And I just put up a poll for the audience, folks. I just wanted to see how many people on this webinar tonight already currently own at least one rental property that you're holding and collecting the rent on. So a medium to long term buy and hold rental property. If you haven't filled out that poll yet, go ahead and add your answer there. And Diane is basically looking like about 87% of the people on this webinar already own at least one rental property, 85% or so. And then the other 15%, maybe newer folks that are looking to get into the rental property real estate investing game and want to make sure they have their tax strategy in place before they start, I presume. So yeah, well, it's about an 85 to 15 split.
Yeah, thank you. I don't see that on mine. I think maybe you're just getting that when you set it up. Okay, so the next part of the strategy is you've got to figure out, after you've kind of decided, I've got a business, I've got an investment, I need to be concerned about the self-rental. That one, you just want to take it to zero, whatever that is. But the business and investments, it becomes a little trickier because now we're looking at, do we want profit? Do we want a loss when it comes to filing your tax return? And by the way, I'm talking about this. This is all legal. It's not like we're cooking the books or doing something bad. There are absolutely legal ways that you can adjust your taxable income on your real estate. And one of the biggest keys is by using the 3 types of real estate expenses that you might have. Number 1 is what we call direct expenses. Direct expenses are things directly involved with that property. So that might be your mortgage interest, your property tax, your HOA dues, your property management fee, the utilities if you've got it. If you didn't own that property, you wouldn't have that expense. That's a direct expense. Now, indirect expenses, this is where you start to kind of hit gold here, because there's going to be things that you already have as expenses, but they might be just personal deductions, so you don't get any write-off at all. But if you can show that those really are used in your business, then they become a deduction. And examples of that would be your computer, your internet service provider, your ISP, your cell phone, some of the business miles on your vehicle, a lawnmower if you're using it for maintenance, whatever that might be. You've got things that you've got current expenses that really can be legitimate deductions. The IRS tells us that in order to be a deduction, it has to be ordinary and necessary to the production of income. And, there's a lot of things my husband loves tools. So he's buying tools because we have real estate. So just as an example, those are the kinds of things you can take a write-off on. Now, when it comes to filling out your tax return, you want to make sure you always take the deduction for all of the direct expenses. And you take that same deduction, take for all of your indirect expenses. Even if that creates a loss that you can't then use against your other income. Remember, I talked about if it's passive, you've got some limitations. If that's the case, fine, take those anyway. That loss becomes a suspended loss that you rolls forward to a time when you might have other income, or when you sell your property, it adjusts then for the amount of gain you've got. So always take your direct and your indirect expenses. If you don't report all of those, it's very difficult to go back. You can file an amended return, but only for a few years. You can't go back indefinitely. Take those deductions. Now, the third type of expense, this is where the real magic is, and this is what I call a phantom expense. It has to do with depreciation. Depreciation actually can be turned off. It can be ramped up. You can catch it up. You can suspend some of it. You can absolutely legally manipulate the amount of depreciation you take as an expense. I call it a phantom expense because it doesn't cost you any cash. It's not out of pocket, unlike the computer you had to buy. Yeah, you got a deduction, but guess what? You also had to pay that money to buy that computer. Depreciation just kind of goes with the property. Now, you can, if you're in a spot where you've got a loss at this point and you can't take that loss, I recommend that you don't take your depreciation expense. The reason is that, yes, it's a suspended loss that you later at some point get to take advantage of. But in the case of depreciation, when you sell for profit, you have to recapture at a higher tax rate than your capital gains. And so you might reduce your capital gains so you pay less tax there, but you have to turn around and pay more tax at a higher rate by having that suspended depreciation. So just as a strategy there, it's really easy to kind of knee-jerk this where you just always take depreciation, you don't think about it. But if it's pushing you into a loss you can't take on your current tax return, think about suspending it, at least for a while. You can also accelerate it. Now, that might be the case of you've got a lot of extra income and maybe you want to create a loss you can take. So you're a real estate professional, your income's below that $100,000. So that makes sense that you want to have a lot of loss. You do that by doing something called a cost segregation study. And that, by the way, is something you can do yourself if you can demonstrate you've got some basic real estate or engineering or architecture or construction background. If you've got that, you do this and basically pull out the value of personal property inside that, whatever that real estate property is. So let's say you buy one of Matt's houses and it's got a garbage disposal and a dishwasher, an HVAC system, and some carpeting. Those are all things that have got a shorter life than the regular real property depreciation of 27.5 years. So you might have something that's 5 to 15 years. In that case, you have shorter lives. That means more depreciation at the front end. That's what a cost segregation study does for you, is you get to really front end load the depreciation. Now, it could be that you turned it off for a while, you didn't have any depreciation, or you just were doing it over 27 and a half years. Well, you can do a cost segregation study and then do a retroactive catch-up on that, creating a big loss. That's why I love depreciation. There's a million different strategies with this, and they all are different. Remember, I was saying that you've got to make sure you're customized on that. The thing you don't want to do is try to do this catch-up depreciation, do a cost segregation study, and create a huge suspended loss. That then becomes a problem down the road. Remember, you've turned capital gains, lower taxed income, into this recaptured depreciation that you pay higher tax on. And by the way, this all is being recorded, and I know Matt's going to put this up so you can come back and listen to it. So I'm talking really quickly through stuff that I normally would take. We talk about each of these for at least an hour, but I want to make sure I give you good tools today that you can use. And a lot of people are right now looking at the 28 tax return, trying to figure out what on earth to do with it. These are things to have discussions with your tax preparer about. Okay, on to question number 3, which doesn't. Oh, here we go. Can you take a tax loss? So after you've kind of got the beginnings of this figured out, now we've got to look at this. Do you have the ability, if we create a tax loss on your real estate, can you take that loss against your other income? If you can't, dial back your depreciation. If you still have a loss, well, that's the way it is. Don't do anything differently with your direct or indirect expenses. If you have a real estate business, remember that's where you're flipping, or you've got an Airbnb, or one of those vacation rentals that's a shorter term. If you've got that, then this isn't as big a deal, because as a business, you get to take a business loss against your other income as a deduction, as long as 2 things: basis and that you actively participate, which is a pretty low standard. So at that point, it's not as much to talk about. You just need to know the answer to those questions. Question number 4, a big one. Do you qualify as a real estate professional? This has been around for a while, and people have wondered, is it still there in the Trump tax plan? And the answer is yes, it's still there. Hooray, because this is a good one. If you're single, then you alone would have to be the one to qualify as a real estate professional. If you're married, filing jointly with your spouse, one of you, either one, could be the real estate professional. Now, there's 3 steps, 3 tests that you have to pass in order to be a real estate professional. Number 1, you have to have at least 750 hours in the year on real estate activities. And the IRS is pretty specific on what those activities are. They're things like being a real estate broker or agent, involved in construction, involved in leasing out your property, in redevelopment of your property, and be actively involved in something. That, and like I said, there is a list that the IRS gives us. That's 750 hours and more hours in that real estate activity than any other trade or business. So you're going to have to keep track of a couple of things there. One is you're going to have to keep track of, do you have 750 hours? And then number 2, if you have another business, especially if it's a business, face it, if you've got a business, you may be working 4 hours a week, you may be working 80 hours a week. The IRS, if they come into challenges, they're going to try to prove you're working 80 hours a week. So you're going to have to prove that you've got less hours in the business than you do in the real estate activity. So yes, we are talking about probably keeping some kind of calendar, a journal. I personally I have a Mac, and I just keep track of my calendar and what I do every day. And it seems to store it forever. I never have had a problem finding the hours and what I'm doing. That's test number 1. And by the way, if you're married, filing jointly, one or the other of you has to meet that test. You can't both add your numbers together. It's one or the other. Number 2, you have to have material participation with that property. So this is a little harder standard. If you do have a property manager, basically the IRS is wanting to see 500 hours of activity related to that property. If you don't have a property manager, there's a couple other tests you can do. And then 3rd, each property stands alone, which makes people's heads spin, because what if you have 10 properties? We're talking 5,000 hours? No, that's not going to work. But so what you can do is do an election with your tax return to aggregate all of your properties, and you only have to meet the test once. Now, here's a little bit of a pro tip. The IRS, if they audit you, are allowing people to make a retroactive election on this. Now, there's a benefit to doing that. Don't make the election, and then if you go get audited, just say, oh, oops, I'm going to do a retroactive election. The reason is because if at some point you sell one of those properties inside of an aggregated group and it sells for a loss, you cannot take that loss if it's inside an aggregated group until all the other properties have sold. That loss has to go against those first. So you could be years down the line. Now, we don't buy property with the idea that they're going to go down in value, but unfortunately, this particular rule caught some people in the bad days of 2008, 2009, and people had not bought it's smartly looking at their cash flow, and so they were upside down and they didn't have enough cash flow. They had to sell quickly, and it ended up being a problem because they couldn't take advantage of those losses against other income. So just be aware of it. I mean, we certainly, like I said, don't buy for something to go down in value, but you never know. Okay, fifth question. Now, this is one that takes definition because we got brand new terms this year. This is effective January 1st, 2018. It's called QBI, or Qualified Business Income. The IRS gave us a set of Treasury regulations, and it was 1,029 pages they gave us in 2018. And then they followed up with, 600 pages or something on just this one topic, this qualified business income. And the reason that it's important is that if you have what's called QBI, then you get to take a 20% deduction. So if you had $100,000 of QBI, you get a $20,000, 20% deduction. You only pay tax on $80,000. I mean, that's pretty sweet. So with real estate, we have kind of some funny things going on. Well, first of all, business, as long as it's in a flow-through entity, I mean, that could be just in your own name, which I never recommend. I recommend you putting in an LLC. But if it's just it flow-through on a Schedule E, or Schedule C if it's a business, or if you've got it in an LLC, if you've got it in a partnership, if you've got it in an S corporation, any of those are flow-through entities. In that case, if you've got income there, you get that 20% deduction. For the real estate business, that's the fix and flippers or the Airbnb guys. Easy. Real estate passive income is not quite so simple. So if you have income, even after you've taken advantage of your depreciation and done all of that, if there's still income in there, the IRS has now got some new rules, and they say that one of them is that you have to group your real estate together in what they call enterprise groups. And basically an enterprise group is you put all your residential in one pile and you put all your commercial in another pile. Okay, great. We got two different groups. Now, each group needs to qualify individually in order to have this QBI. And one of those is that you or your agents need to spend 250 hours a year of work on that property. Okay, now agents could be, this is, by the way, a fairly simple test. Agents could be your property managers do it. Could be the guy who's mowing the lawn is part of those hours. It could be all these things. You just need to track it. And then the IRS added the third one, which is, this is how they want you to track it. They want you to write down the name of the guy who's doing it, whoever that person is, what they're doing, when, and how long it took. So it would be Joe Smith painted the unit from 8 to 5 on Monday or whatever, February 15th. I'm just making up stuff. I don't even know if that was a Monday. But the fact is, that's the kind of detail they want to see. Now, they did give us a break since they told us about it in February 2019. They're saying, well, guess what? You don't have to do it for 2018, which I think is awfully generous because who on earth could have done it for 2018? But they are telling us you have to do it for 2019. So starting January 1st, one of the things you need to do, and yeah, I know we're several months past that already, but a conversation you need to have with your property manager, and then they should have with all of their independent contractors that come in to fix things. You need to have them keeping track of this. Give you timesheets. This is the only way, if you've got income in that property after you've got depreciation, that you can get that QBI 20% income deduction. Okay, now I'm going to keep, but I can't see if we're getting questions as we're going. You're going to just open it up later?
Yeah, we are getting some questions, but what I want you're actually answering some of them though as you go along.
Okay.
And so what I want to do is hold them all to the end for that reason, because I think you're going to cover
Okay.
some, and then we're going to have an open floor Q&A at the end of the webinar.
Okay. Yeah, I've probably got about another 5 minutes or so, and then so we've got time to do that.
Sure.
Okay. Okay. So what I want to do is talk just for a minute about my firm and what we do. We are a virtual CPA firm, and like Matt said, he's one of our clients, has been for years. And we have CPAs that have got experience in real estate and business and a whole range of things. And then we all work remotely with you. The goal, though, isn't just to prepare a tax return. And I sometimes get this is that people will say, well, how much does it cost to prepare a tax return? And I can certainly tell you that, and we're competitive. But the reality is what we'd really rather do is work from you from the beginning and help you with strategies. So you're protecting those assets and you're paying less taxes, which all means more cash. And with more cash, you can grow this all faster. And you're doing this without having to worry about the IRS breathing down your neck. And by the way, the IRS these days is kind of the least of some of our problems. If you're investing in some states, there are some states that are getting very aggressive, and we're on that too. We know where they are, and we know what the issues are with those states. So you could save money on taxes, but then spend 100 hours getting ready for an audit you don't want. So the idea here is what can we do to lower your profile legally so that you're much less likely to turn up. So if you'd like to find out more about our firm, I do group coaching. It's twice a month. I do personal consulting. We've got year-end tax services. We do audit representation for state and federal. And then a biggest part of what I like to think we focus on is that we've got unique information that's tax related for asset protection and growing your cash flow for your business and real estate strategies and education. If you want to get some more information about that, well, you know what? I was going to put my husband's email up here, and I guess I didn't. I'm going to have to just say, go to ustaxaid.com. You'll see some buttons in there, and go ahead and click on that. I'm really bad at doing things about follow-up on that. My husband is Richard. Give him a call. He can talk to you about your circumstances and see if this is a good fit for you or not. Now, what I said to Matt is I've got some new information that's all related to the Trump tax plan. And I want to do a special deal. And when I say this is a special deal, it really is. It's just for Matt's people there at Maverick. What it's called the Real Estate Accountant in a Box. There's 17 home study courses module. There's audio and video, and they're all examples that you can use to do exactly those goals we're talking about. Plus, I'm going to give you a copy of my new book, which is Taxmageddon 2018. It's #1 in 8 Amazon categories. And we're going to throw in 6 months of that live group coaching I was talking about. That's twice a month. One session's real estate, one systems business. But the interesting thing is there's some crossover. Even if all you're doing is real estate, I recommend you listen to the business as well, because you might find that there are some things you want to do. I have a number of clients, even though they're working W-2 jobs, regular full-time, are starting little side businesses, doing online businesses, e-commerce, and that type of thing. So there's a lot of play you can do between business and real estate. I'm also going to give you 50 hours of the audio coaching that I've got. The total value for all of this is a little over $4,600. Now, here's the special offer that's just for Maverick clients. When you go to ustaxaid.com/make-more-money, and it is case sensitive, so make more money with capital M's on all of them, you'll see there's a coupon code. You need to type in Maverick, all in caps, and then you're going to get this for just $497. If you go to my website, normally it's $997, and you don't get all those bonuses. So it's $497 just for all of you guys. Thank you. This is just a picture of what this looks like. There's 17 standalone home study courses, but they do all come together. But I have to make a confession here. This was all done, ready to launch when we got the Trump tax plan, and then we got the 2 new addendums to it in 2018 and then February 2019. So I'm going through and rewriting it and re-recording audio for all of this. So what you're going to be doing is over the next 4 months, you're going to be getting these new these new home study courses along with the coaching. Remember, we got 6 months of that. So you're going to be getting these in pieces as they're developed with the very latest in strategy. I just want to warn anybody who's right now maybe looking at buying real estate tax books or getting information online. One of the things to do is to be really careful what the date on that is. I do a program called Tax Minute, and it's 60 seconds every day. And I put the date, I recorded it in the title, because things are changing so quickly that what worked yesterday might not work tomorrow. It's not just that the Trump tax plan was so massive in all the changes that it had. It's that we're now seeing the Treasury Department and the IRS interpreting what that all meant. And it's interesting, you get 1,000 pages of code, of tax code, but now the interpretations is going to be 10,000 pages by the time they're done, section by section, working through it all. Just be careful as you're going through that information, what you've got. I want to just gave you a promise that you can go to ustaxaid.com/Maverick, and I don't think I've got a password on that one for Maverick. I think if you just go to ustaxaid.com/Maverick, you're going to get that free PDF cheat sheet that's going to show you the things I talked about today and the questions you need to ask in the order you need to do it. I think that's probably a great place to stop. I'd love to get your questions, and we can just kind of talk for the rest of the hour on all of these tax strategies.
Awesome. Well, I don't know about everybody here, but my head is almost spinning from the substance of how much content we just received. And I can't believe we brought that in just 45 minutes. But yeah, bravo, and well done to you, Diane, for doing that efficiently. But yeah, folks, just go ahead and this is now the Q&A part of the webinar where you get to ask Diane Kennedy any questions related to this content that you would like, any of your personal questions or anything else like that. Feel free to type them in right now. I'm going to read them out to her, and we will just go through them in the order that they come in. So, okay, Dan, the first question is from Mike. He says, I had a bad REIT investment that went wrong where they filed for bankruptcy. I invested $50,000. And can I offset this loss from, can I use the $50,000 loss of the REIT to offset my rental income and or paycheck?
Okay, so the REIT is going to be subject to capital loss. I'm going to guess it's going to be subject to the capital loss rules. There might be an exception in here, and so I'm just going to kind of leave a door open. If you've got, I think the code section is 1244, which if it's a small business corporation is what I'm talking about. There is a change that you're not limited to the capital loss. Otherwise, it's just $3,000. Unfortunately, you can offset other capital gains so that if you had some stock you sold or some crypto or something else that you sold that went up in value and it was a capital gains, including real estate that you sold. Otherwise, unfortunately, you're going to get that just for $3,000 a year, which is, gosh, what's that, 16 years to get the full write-off on that? I wish I had better news on that. Unfortunately, I think that's probably going to be the case that you're in, unless you somehow fit into that small business corporation loophole. The best thing to do is to talk to somebody about that. By the way, on the bankruptcy, on the REIT, if there was any fraud or anything involved, you might also have something else. I mean, if there's criminal charges pending, or, I mean, I certainly hope that didn't happen. But if that did, there might additionally be some other ways around that too.
All right. Next question from David. And David, good to see you on here, my man. We haven't talked in a while, but good to see you. David's question is, with a disregarded LLC, I am putting my income for each property on Schedule E. How do I report corporate expenses such as resident agent fees, annual meeting expenses, etc.? Should I spread these corporate expenses evenly across all of the properties on Schedule E or report some other way?
Okay, and David, actually, you reminded me of one more point I wanted to make that I forgot, so thank you for that question. Okay, so first of all, a disregarded LLC, just in case anybody's not familiar with that is, that's a limited liability company that you set up, and then you just, like, for example, you might be a single member in that, which I think probably is the case for David. He's the only member, the only owner of that LLC, and so then it just reports as just a regular Schedule E on his tax return. Okay, so one of the things that back on that QBI, that question number 5 I had, one of the things that the IRS has said is that in order to take advantage of that QBI, that 20% income deduction, they want to see separate books and records for each property. And we've asked, I mean, my firm has asked, it's in the open period right now of a proposed Treasury regulation. And so we were able to ask a question. My firm has made a formal request asking if that could mean that you have like QuickBooks and you set up different classes, for people who are familiar with that kind of accounting. The preliminary answer is no. It's not definitive yet, but they want to see a separate company set up. Like, for example, if you're using QuickBooks, which is a major ouch. If you're using online QuickBooks, you suddenly it's just gotten a whole lot more expensive. So just be aware of that one. But in answer to your question, David, there's a couple of different ways to do it. A lot of my clients, what they do is just set up an entity, maybe it's an LLC or maybe it's just their own entity that then has all of those expenses. So it just becomes something that writes off against that other income. And that's where you've got your computer and your truck that you use, for maintenance on all the properties, all of those kinds of expenses. And that just shows as another Schedule E with expenses that then nets against all of those others. Additionally, I have some clients that divide it, and that works if you've only got a couple of properties. But if you get any number at all, it just becomes, the administration on that is just too cumbersome. I recommend just lumping them all together and taking that deduction.
Awesome. All right, next question from James. Good to see you, James. James and I hung out a couple weeks ago. He came to our Flying By event in St. Louis. And Diane, James is actually picking up his first two properties and very diligently attending this webinar before he closes. And his question to you is, if I am paying cash and not financing yet on my new investment properties, what should be the strategy for a tax plan since my cash flow will be a lot higher? I'm just starting out.
Right.
Would love your advice on what I should do.
Okay, great. So one of my questions would be, you're buying, I'm guessing, in St. Paul, that, do you live in that state or do you live in, St. Louis, sorry.
Right, yeah, it does not
okay.
live in that state.
Okay, so you're going to be filing a tax return in that state, just so you know that. And it doesn't mean that you end up double dipping if you have income, that you have to pay tax in that state as well as your home state. You end up paying tax in that state, and then it becomes a credit against the other state tax that you've got. Just kind of a note there. Sometimes people think, oh, I don't live there, I don't have to file a tax return. Unfortunately, you do. Now, I would be looking at your depreciation, so I'd really be looking at that cost segregation study. That's something to go through and pull out those personal property items. And another comment, though, might be that maybe you want to not worry about it as much and take advantage of that 20% QBI. Remember that 20% income deduction. So maybe it's just like, well, we're just going to take our income because I'm not going to have to pay as much tax this year. Which is the best answer? The best answer is you do the math on both of them and then a little bit of a projection on what you think is going to happen. I mean, we at this point don't think that 20% income deduction is going to go away, but if it did, it'd be kind of sad to lose that and then burn through all your depreciation right away. The strategy with the depreciation where you front end load that works really well as long as you're committed to continuing to buy more property. Usually the number is about kind of the magic numbers every 7 years. If you buy another property every 7 years, then you can front end load that depreciation as well. And so you've always got something new, like fresh blood, to take all those write-offs against the other income.
Awesome. Diane, next question from VJ. Do you handle tax prep for Canadians investing in U.S. real estate?
We do. We do the U.S. part of it. We can't do the Canadian part of it. Big warning here. In fact, actually, I have quite a few clients that are foreign clients. You just be careful. Everything I was just saying about LLCs and whatnot don't always work real well for Canadians. Matt's nodding his head. He knows about this as well. So talk to somebody who helps you with whatever structure you're using to make sure they know you've got Canadian, that you're Canadian, because the U.S.-Canadian treaty is kind of weird. LLCs, and so you don't want to end up with this double tax issue it might have. But anyway, yes, we do absolutely do that.
Awesome. Next question, is the cost segregation only applicable to big apartments, or can it also be done in single family rentals?
Absolutely, single family rentals. I have a lot of clients doing that stuff. And I think in some ways it almost is easier because the big commercial properties or big residential properties, often you need to hire that done. And that can get expensive. The single family properties, though, there's a very specific template you need to follow. And it's one of the home study courses that's included in the Real Estate Accountant in a Box, and I go through that template. Big part of it is you've got to show your resume. Why should you be able to do that? Well, I am because I own real estate and I understand value, and whatever. The words you need to use on that. And then you get to decide, what value you've got on these things. So as an example, you buy a property for $100,000 and say the land's worth $15,000. You now got $85,000 left. What portion of that value is for the carpeting, is for the paving on the driveway, is for the HVAC, the refrigerator, the stove, those other items. And this is how you walk through that valuation. And I think it's a great tool to do. I recommend my clients do that even at the beginning. And just even if you don't use it right away, it's done so that, oh my gosh, I've got a whole lot more income than I expected. You've already got the tool in the toolbox ready to go.
Yeah, and just along the same lines, I think this is a follow-up or clarifying question about what you're describing there, Diane, with the accelerated depreciation, that this is not just for real estate professionals. This is for anybody with the long-term buying rental property.
Right, absolutely. Yeah, this is a strategy for people who've got that long term. The reason that we talk about it so much with real estate professionals is because it can create a loss. If you take a lot of depreciation, and then if you've got that loss, what are you able to take the deduction for that? Well, the real estate professional always is, but in some cases, like we've got somebody who's paying who's free and clear on his property, and so doesn't have the mortgage deduction. He's going to need that extra deductions anyway.
Right. Okay. The next question is from Andrew. I own 10 single-family rentals. After expenses and depreciation, some properties are positive income and some are a loss. Should I combine all 10 into a total gain or loss for the year?
Okay, so for 2018, the IRS is telling us with this new QBI, if you're looking for the overall part, yes, you need to combine those. So that you're going to find that you kind of are forced to do that now. When you file your tax return under normal pre-2018 time, yeah, it all combined together and that all worked out. That's how it all worked out. If then there was losses that were over and above that, they became suspended. The issue I think that we're running into though is with this QBI, because if they're grouped in an enterprise group together, then you maybe end up being limited in how much of a 20% deduction you get. I wish I could say always do this or always do that. It's almost like you have to go through the numbers together to see which works best.
Right. And just sort of one more follow-up from Matthew, actually, on that. Diane, where can you get a cost segregation study? How does a real estate investor go about actually breaking it out?
Yeah, there are firms that do it for you. Typically, it costs about $5,000 to start. We do sell the template if you want to do that yourself. And as I said, you can go to my website. I think it's $149 to buy just that. Or if you buy the entire home study, the whole package, and you get the coaching and everything else with that, that's $497.
Okay. All right. So the next question from Annie is, I invested in real estate crowdfunding, and this year I expect a loss in principal, probably around $10,000. Can that loss offset my income, or at least offset interest income I made from another crowdfunding investment?
Okay, so my question on the crowdfunding would be, what kind of entity do you have? If it's running like a partnership and you've got a limited partnership interest in that, then you might be limited in what kind of losses and income and how you can offset those. If it's instead like an LLC and you're all manager members and all involved in the management of it, it would be a different answer. You wouldn't have the same restrictions you would if you're a limited partner in a partnership. If you're investing into some kind of pool, I would just ask what kind of structure that is. It almost would sound like it's a REIT then or something like that. Other than the crowdfunding, there has to be some kind of structure behind what that is.
Okay. Next question. VJ is asking, how do you account for an insurance payout for a vandalized property in Georgia when you eventually ended up selling it as is last year?
As it was,
selling it quote unquote as is. I think that means last year. In the intervening 3 years that the property was owned, it incurred losses in repairs and vacancies.
Okay, so that amount, whatever that payout is, the insurance payout is actually income. So that would be just income into the whole deal. My guess is that if you're selling it, and by last year, I'm guessing 2018, and you're doing your tax return now to kind of pull it all together, you've got some suspended losses that are coming forward that adjust your basis. This amount that you got as a payoff is income. It just kind of all goes in a big pot, and then when you're done, you got to recapture your depreciation, and the rest is considered gain.
Okay. The next question, I am looking to purchase a buy and hold duplex. Is it more advantageous to purchase with a conventional loan or with an LLC / hard money loan when it comes to taking advantage of the new tax laws?
For the tax laws, it wouldn't matter. My guess, though, is that you're always better getting the conventional loan, especially if you get that first. What is it now? The first 10 you get the special deal on for interest, right? And so that if you haven't used that up yet, you definitely do that because you're going to get much lower interest. Hard money that's down the road when you kind of used up all your other resources.
Yeah, the conventional lending terms are going to be significantly more advantageous, lower money down, lower interest rates, all lower lender fees, all that kind of stuff. So if you can get those, that's typically advantageous all the way around if you do qualify.
Yeah.
Okay, Diane, the next question from Mo is, can you please explain a little bit more about why depreciation losses should not be taken in some situations? Don't these losses carry forward forever until they're used up? You did go through that a little bit fast, so can you sort of
Right. Okay.
explain
Oh,
that a
no,
little
no
bit?
problem. Okay. So the reason, I mean, with in general losses, we've got those three types of expenses: direct, indirect, and depreciation. Direct and indirect, you always take those because you can't ever catch them up, use them or lose them. In the case of depreciation, though, you can catch it up later. If you decide I'm going to go ahead and take this loss on my deduction, take that expense right now on my return, and it creates a loss, it is a suspended loss. And yes, it goes forward forever. However, if you let's say the property never has income that uses that particular property, never has income that uses up those losses. So when you sell it, you have to recapture that depreciation. And this is the tough part of it, is that recapture is done at a higher rate than the capital gains would be. So as an example, let's say that you're at the highest tax bracket. You would have a 20% capital gains rate and a 25% flat depreciation recapture. So by taking that depreciation early, you've ended up just suspending this loss and paying more tax on it. True story. I had a client who came to me, who was a doctor, came to me the year after he had retired. And he was building up his real estate, and he'd read my book, and he knew about cost segregation studies. And so he had his accountant actually learn how to do them. He paid him to learn how to do them. He did a cost segregation study on all of the properties, created this huge loss. The doctor was still working as a doctor, so there's no way he could qualify for that to take as an expense, and he had a huge suspended loss rolling forward. Retired the next year, and he would have more hours in real estate activity. Even though with his retirement he got this big cash out bonus, so huge income, he still qualified as a real estate professional. Now the problem was the next year they had already the year before taken all those losses and had done that catch up depreciation. So huge suspended loss. Now that loss could be used against other real estate income, but it couldn't be used against his other income as a doctor or his other income that he had, even though he was a real estate professional. If he'd waited 1 year on doing that, we could have done all of those things and he would have paid tens of thousands of dollars less in taxes. But I just don't ever like doing suspended losses, especially with depreciation, because it's not use it or lose it. You can always catch it up later. But once you've taken it, you've taken away that flexibility that you might have. But who knows? Maybe you hit the lottery and you need a big write-off, and now we can take those, and you can take all of that deduction. Otherwise, if it's suspended, it's just stuck.
So, a follow-up question on that from Joseph. He said, I was told, presumably by a CPA or someone, that depreciation is basically automatically assumed that you've taken it, even if you don't. Are you saying that you don't have to take depreciation when you file and it's not automatically assumed that you've taken it?
I'm absolutely saying that. I'm right now trying to rack my brain, trying to remember the year that changed. It was either 1994 or 1996. And either way, over 20 years ago, this was a question that we had, and I have been a CPA for that over that long, and I remember this, that there's a part in the law that talks about when you do that depreciation recapture. Remember, we hate that because it's that flat tax rate that's higher than capital gains. But it said that you have to add in depreciation that was allowed or allowable. And that made all of us CPAs heads spin because we had the concern that if you don't take your depreciation, it was allowable. And if you didn't take the deduction, you're going to have to add it back in either way. And so that for a long time was the strategy. Over 20 years ago, the IRS said, nope, that's not how it works. This is how it works. So they did clarify this. And I'm still amazed because this is a question I get frequently. It's not just an isolated incident. A lot of people still talk about this, and it's simply not true. It changed over 20 years ago.
That's a really important. That's a really important clarification. Awesome. All right.
Yeah.
Well, we are just hitting the top of the hour, and I think we have just gotten through all of the questions. If you have additional questions, obviously, Diane provided her company contact information here, and you can reach out directly if you'd like. But we're going to leave it there for the evening. Diane, thank you so much for
you bet.
the super substantive, as it always is. And I'm sure everybody got as much out of it as I did. So thank you for coming on.
Oh, great. Thank you for having me. It was nice. I love the questions.
Awesome. Thanks, everybody. Good night.
Good night.
You
bet.
The super substantive, as it always is. And I'm sure everybody got as much out of it as I did. So thank you for coming on.
Oh, great. Thank you for having me. It was nice. I love the questions.
Awesome. Thanks, everybody. Good night.
Good night.